Our Mississippi State Alumni Homebuyer Workshop. My name is Jason Maida. I'm going to be your host and facilitator this evening. It's great to be with you all. I'm really excited to get a chance to bring this content to you. We're going to have a pretty busy class tonight. And so we're going to allow everybody to get into the Zoom session. I know we're just about a minute past the top of the hour, but we'll allow everybody to get into tonight's session. While we're waiting for that, just want to give you guys some logistics on tonight's meeting. So we're going to have about a runtime of about an hour. So we should be finished up by the top of the hour. We try to make these very interactive sessions. So as I go through tonight's content, we'd encourage you to ask some questions on air. You can do that by using either the Q&A function within Zoom, or you can use the chat function, whichever is easier for you. And we're going to try to bring you a lot of great information and some tools and resources to help you on that journey towards homeownership. I know many of us are joining from kind of different parts of the country. So if you got some time while we're waiting for the rest of the guests to join us, if you want to just put in the chat where you're joining us from, what city and state, we'd love to kind of know where you're at, because as we go through tonight's session, we're going to talk about different market data and how that could impact you on your path towards homeownership. Yeah, so if you're willing to kind of share with us your location, that would be awesome. I happen to be on campus at Mississippi State a couple of weeks ago. Leanna and I got a chance to hang out, get a tour of campus, and I made my way to the bookstore. As you can see, I'm rocking my hat here, so we got our cowbell too. So we are all totally set with all of our gear for tonight's class. So for those of you that did get a chance to drop in the chat, appreciate that. So a lot of us from Mississippi, look like Louisiana. Great. Appreciate that. Very cool. All right. Very nice. Okay. All right. All right. We got someone in Mississippi moving to Texas. Okay. That's great. All right. Well, I appreciate everyone kind of chiming in. I know there's many of that have signed up for tonight's class that are going to be joining us a little bit later. I did want to let everyone know. So tonight's class is going to be available as a recorded version up on our YouTube channel tomorrow. So, take great notes tonight. I think it'd be super helpful for you in the retention of some of this information, but we will have tonight's class recorded and up on our YouTube channel tomorrow. Well, a little bit about our organization and myself. Well, I work for a company called American Pacific Mortgage. We're a nationwide lender, and we service all communities across the country. Our team in particular has partnered with Mississippi State alumni to bring to you homebuyer education like a class like this to help you on your path towards homeownership. And I facilitate classes like this usually once to twice a week with different partnerships all across the country to be able to help educate those that are considering homeownership as part of their financial plans in the future. All right. A little bit about me. I've been in the lending world for over 20 years. I specialize in first-time buyer programs and really kind of equipped to help guide first-time buyers and that. I love getting a chance to present classes like this. So through our partnerships, I get a chance to meet just a lot of great people that we can help create home buying plans for them and kind of really help them on that path towards home ownership. Today's class agenda is going to look a little bit like this. So we're going to talk about the housing market in just a bit. We're going to do a budgeting analysis. We're going to kind of look at what does it look like to rent versus what it could look like to buy. We're going to give you a kind of a what if scenario. We're also going to spend some time looking at interest rates and what's going on with interest rates. A lot of hot topics there. We're going to spend some time diving into credit and how we can kind of get our credit in the best possible position for qualifying for home financing whenever that time comes. We'll talk about student loans and how those can impact qualifying. We'll look at loan programs, some documentation you might need to start gathering if you do want to help get yourself on that path towards home ownership and meet with us for a consultation. We'll talk about various assistance programs that are available all across the country. I know a majority of our audience is here in Mississippi and Louisiana and Texas, but there are assistance programs available all across the country. We'll dive into some of the nationwide programs, and then offline, we can certainly talk with you specifically about your situation on a particular first-time buyer product. And then finally, we'll talk a little bit about the buying process. So after tonight's class, I want to learn a little bit more about what my options can be. We're going to kind of share with you what the steps in the process will look like. We call that the 6 steps of home buying. And we're going to explain to you a little bit more about what a consultation could be like to help you with this journey. Well, let's talk a little bit about buying because it does, it's something that's going to be, first of all, it's going to be one of the biggest financial decisions you're going to make in the upcoming years if you do decide to pursue home ownership. And there's a lot of great benefits that come with home ownership. You have the opportunity to create stability or affordability through the selection of your home price. This is an opportunity to create equity in your home. So whatever the market value of your home is versus what the balance is, that difference is called home equity. And hopefully over time, that equity should increase. So as I pay down my balance, the market value of my home goes up. That creates more equity. This is an opportunity with homeownership to potentially create generational wealth for yourself. And so that's another great outcome of homeownership. And there's still some really great tax benefits that can come along with homeownership. So when we coach clients on homeownership, we just remind them that it's not necessarily an apples to apples comparison. So if I'm comparing my rent of $2,000 a month versus $2,000 in a mortgage payment, those don't necessarily add up because all the great benefits that come along with home ownership. So I think it would be important for us to, first of all, dive into an exercise of budgeting first in building out our home buying plan in our discussion points for tonight's class. So I'm going to walk you through a rent versus buying analysis so we can kind of take a look at how those benefits of owning versus what they look like as compared to renting. So let's take a look at our calculator. And in case you missed it earlier, I'm going to share with you guys all of tonight's class. It's going to be recorded, but we'll also send you all of our presentation material so you too can actually use a calculator like this to run your own budget analysis. Now, we've kind of just put some arbitrary numbers here in the calculator. I do realize that depending on what part of the state you're in, the cost of living is going to look a little bit different, but ultimately the math and the equation should look fairly similar. So let me walk you guys through this rent versus buying calculator. And we're going to first start off with what it looks like from a rental perspective. So I have in this calculator, $2,000 is rent. And I do realize that could be a little bit lower depending on where we're located. We have monthly renter's insurance projected at $15 a month. We have our assumption that our rent would increase 5% every year when we renew our lease. Then we have our home purchase price. And so we put in 425 as a purchase price here. I do know as I meet with clients throughout the country, that number is going to vary. But let's put 425 for now. We have a minimum down payment of 3%. You're going to learn more about that in our product section as part of tonight's class. So 3% is the minimum down payment for a conventional loan. We have the assumption around property taxes. We have homeowners insurance that we want to add in. We also have maintenance costs that we want to build into our equation. And so all of those are going to be on the homeownership side. Okay. Now, in our loan information section, we're going to assume a 30-year fixed mortgage. We have an average interest rate of about 6.6%. That does vary by the day. We're going to spend some time talking about interest rates in just a few minutes. We have origination charges. So those are costs that you will incur in financing. Now, one of the cool things about our partnership with Mississippi State Alum is that we actually discount our services. We provide a $750 discount in closing costs in partnering with APM for your home financing. So another great opportunity for you beyond your educational resources you have here. Now, there are discount points that you can elect to pay as a consumer. And what discount points are is when you as a buyer decide to put additional costs out of pocket to bring down your interest rate. So if the interest rates today are 6.6, but you really want to achieve an interest rate of 6.25, you could pay additional costs out of pocket called points to bring down that interest rate. All that being said, I really don't recommend points at this time in the market because the break-even point with those investments generally are about 3 to 4 years. And quite honestly, most of our buyers buying in today's market of either 2024 or 2025 are probably going to refinance in the next couple of years. So that investment of points doesn't necessarily make a lot of sense. Then there's other settlement services. When we think about that category, it's all going to fall under closing costs. Closing costs are going to include like attorney's fees for the transaction, title and escrow fees. Those are all part of closing costs. I generally recommend buyers to estimate about 2 to 3% of their total purchase price in closing costs. And then the last section is the other assumptions that we'll make. We're going to assume that our home will appreciate about 4% on an annualized basis. We expect to be in this home about 7 years. So when you see the calculator come back with the results, it's going to say 7 years of renting versus 7 years of home owning. So we'll look at the difference there. We also project in the cost of selling that house at the end of the 7 years. We have state and federal taxes, and then finally a savings rate in comparison. And we all know savings rates are quite high right now, given the level of interest rates. So when we look at our calculator, we look at, first of all, our increase in monthly budget. So we know that we're spending $2,000 a month in rent. Now, from a home ownership perspective, that's going to make our mortgage payment go up to about $3,600 a month in rent, or sorry, mortgage. So that's obviously a pretty swift jump upwards. Now, the opportunity over 7 years of buying versus renting is about $50,000. When I factor in the appreciation of my home over the next 7 years, some of the tax benefits that also come along with owning a home. So that's why I think it's really important as first-time buyers, as we're considering starting this journey towards home ownership, we really kind of get a good handle of what are the benefits of buying going to look like versus renting. Because quite honestly, for some of our clients, it doesn't necessarily make a lot of sense because maybe they have a really cheap housing situation. But for others, it really does make a lot of sense. I would encourage you in our audience tonight, if you have some time, take a look at that calculator. I think it'd be really enlightening for you to walk through that exercise. And, if you're at a purchase price of 250,000 or 200,000 or 150,000, whatever the case, the number is, that should be able to map up and show you the differences between owning and versus renting and what those positives or negatives might be for you. All right, so that's our calculator there, and I think it's a great jump start into our next topic, which is the housing market, right? So we do realize the housing market is relatively expensive in all parts of the country. We're going to give you kind of a snapshot of what the housing market looks like collectively across the country, especially because a lot of us in tonight's class are in multiple states. But I do think for most parts of the country, it looks very similar. We have very limited inventory in the market, so not a lot of sellers willing to put their homes on the market. A lot of that is attributed to what we saw in interest rates in 2020 and 21, where sellers were refinancing their rates, their mortgages into the 2.5%, 3% range. Well, many of those sellers aren't willing to replace those interest rates with 6% or 7% rates in buying another house as their move-up situation. So that's why we kind of a little bit of a stall in the inventory levels. Now that's improving a bit. We're projected to see about a 10% lift in inventory levels this spring and summer buying, which we're right in the middle of right now. And so, home appreciation is going up a little bit. We see about a 7% appreciation. That will vary a little bit by state and what we're seeing, but I'm kind of giving you more of a national look at things. We can kind of go down a little bit deeper into the numbers, look specifically at Mississippi markets, or if you're in Louisiana or Texas or any of the bordering states, those numbers specifically. But it is a very similar challenge in lack of inventory, but still relatively strong demand from buyers. And that demand still remains relatively strong given the interest rate environment. And so, when we look at today's average interest rate, which is kind of hovering around the 6.8 range, give or take, those numbers are kind of fluctuating on a daily basis. As I get a chance to work with clients throughout the day, we're keeping them apprised of what's going on with interest rates, but those interest rates can change by the minute. I think it's important as future buyers to understand how we got to this place from an interest rate perspective. As we all kind of fill it in our monthly budgets, things are more expensive, right? We go to the grocery store, that gallon of milk's a little bit more expensive. Those eggs are more expensive. Fuel's more expensive. Guess what? Housing's more expensive. And we're seeing that on the impact to interest rates, because inflation is what's driving interest rates right now. The Federal Reserve has tried to combat inflation by raising the Federal Reserve rate, which in turn has obviously raised the 30-year fixed mortgage rate. And we're starting to see some signs that inflation is improving. The Federal Reserve's goal is to get inflation down to 2%. But it's really kind of a day-by-day situation with economic news. We saw some spending reports that just were not favorable. Consumer spending was down. And it's going to put the Federal Reserve in kind of a precarious position on what they do with the next possible rate cut. A lot of speculation is the Federal Reserve will cut rates in September. Could be the end of the year. Originally forecasted was 3 rate cuts for 2024, but now we're down to possibly 1 rate cut. But if we get more weakening signs in the economy, like consumer spending being so far down, we may see a potential change in that theory on rate cuts. So, but at the end of the day, today's rates are right around that 6.8 level. We've seen this is kind of a 12-month snapshot of interest rates. Unfortunately, we've seen a roller coaster ride in interest rates. Going back to October of last year, rates topped out at 8%. But luckily seen a kind of a swift downward move, and interest rates have been in that 6.6 to 7% range over the last, I should say, 5 to 6 months. All right, now we really want to watch what interest rates are doing because obviously that affects buying power. But there's various characteristics that go into interest rates. It's not a one size fits all for interest rates for all clients. And here's what goes into that. Credit eligibility plays a factor. So the higher my credit score is, the improved my interest rate is going to be. The type of product that I'm going to elect, how much I decide to finance, what my down payment is. We talked earlier about discount points. That gives me an opportunity to bring down that interest rate a little bit. And then the term of my loan can also impact interest rates. Traditionally, first-time buyers are going to elect a 30-year fixed mortgage. But if I decide to shrink that term down to maybe a 20-year or a 15-year fixed loan, traditionally that will lower my interest rate options. Now, for affordability, most first-time buyers will elect a 30-year loan. But if you're trying to achieve a lower interest rate overall, then that shorter term could help you. Now, as we meet with clients for what we call as a consultation, we're going to figure out what the right design is for you and give you some insight as to what interest rate and product matches up best for you. Because that's obviously a big part of building a home buying plan for our clients. One of the biggest factors that contributes to interest rates and the offering a client has is credit. And when I think about working with hundreds and hundreds of clients across the country, there's two general challenges that come in light with buyers. Is going to be, assets, and that's because they just haven't saved enough, or it's credit because my credit's maybe a little overextended or not in the right position. And so we really want to help educate first-time buyers on how to optimize credit scores. So let's first of all better understand what goes into the FICO score calculation on the mortgage credit score. And by the way, there's 3 different mortgage credit scores. There's the credit card score, there's a auto financing score, and there's a mortgage score. So of course, what we're going to use on the financing side for us is the mortgage score calculation. And here's kind of the weighting of the scoring. So 15% is going to be how long have I had credit. So the more mature my credit file is, the better my score could be. 20% is going to be how much new credit am I trying to get access to? Am I opening a lot of new accounts? Do I have new inquiries on my credit, specifically hard inquiries? That's 20% of the overall weighting. 30% is going to be how much do I owe on my revolving accounts? That's also known as credit utilization. The rule of thumb is you at least want to have your credit cards below 50% utilization of credit. Optimal is going to be below 10% utilization. So if I have $10,000 in limits and my balances are at $6,000, I'm at 60% utilization. I want to do my best to try to get below $5,000 in balances because then I'll get a next improvement in my score. If I'm really trying to achieve the 800 plus score, then I want to try to get those balances below $1,000. Now, I would give you kind of a quick tip here on how to manage the utilization best. And I would encourage you to take a look at your most recent credit card statement. There's 2 really important dates on those statements. One is the billing cycle or statement date. The other date is your due date. We're all familiar with the due date, which that's when we have to remit our payment. But I would ask you guys to take a look at your statement date because that's the date at which the credit card issuer is going to send all the information to the credit agencies. So to TransUnion, Equifax, and Experian. If you can get in the habit of paying down those balances before the end of the billing cycle or statement date, what you're going to do is you're going to bring down your balance before they report out to the agencies and hopefully give yourself a much more improved credit score. And then finally, payment history is going to play the biggest role in your credit score. That's going to be 35% of the payment history. So late payments are going to be rated as 30-day lates, 60-day lates, and 90-day delinquency. So the most severe I'm on that spectrum of late, the bigger impact I'm going to have to my score. Specifically in the most recent 12 to 24 months, we're going to have the biggest impact to our score. So, if I've had a recent late payment, I want to be aware of that, the timeline of that, because if it was just in December of 23, it's probably hit my score a little bit harder than, say, a late payment that I had in December of 2020. Now, every product has a minimum credit score. We're going to spend some time looking at products in just a few minutes, but you can see some of these core products that you have on screen, minimum credit scores with the government-insured FHA loans, 580. You have the conventional loan at 620, the VA insured loan at 620. So those are kind of give you a sense of some of those minimum credit score requirements. Major events on your credit report, like a bankruptcy or a short sale or charged off accounts, those are going to have a bigger impact on your score. And I'm going to show you how long those will stay with you on your credit report. The further we can get away from those events, the better. But in the most recent 12 to 24 months, that's going to have the most impact to your score. Now, account closure has to do with taking a revolving account and completely severing that relationship with the creditor. When you do that, you got to be careful because that can do two things to your credit. One is it can impact your length of credit, especially if you've had that account for a long time. Two is around credit utilization. When you've closed out that account, it also strips away that credit limit as part of your aggregate utilization. So you want to be really careful of that, especially if it's a long-standing account. You could damage your credit score that way. There are 3 agencies that we've talked about. All 3 of those agencies have a different credit scorecard, and they all give us 3 different reporting scores. So I think it's important to understand that on the lending side, we always use the middle score of all 3 bureaus. So for example, if my middle score, or my high score, I should say, is 770, my middle score is 750, my lowest score is 730. From a qualifying perspective, we're going to use the 750 score for eligibility. And that's important to understand because that impacts your interest rate, your product offering, even mortgage insurance on a home loan. Now, if I have a partner that's also going to join my home buying application and their scores are at 700, 680, and 660, well, that changes it up a little bit because now we're going to use the middle score for my partner, which is the lowest middle score between the two of us. So then that interest rate, mortgage insurance, the loan programs, all going to be based upon that 680 credit score. All right, so here's a matrix that kind of shows you how long negative items will remain on your credit report. So again, the more severe the event on the credit report, the bigger impact it's going to have on the credit side of things. All right, we're going to dive into student loans next, but I just want to make sure to do kind of a quick check-in with our group. Any questions from the audience that I can help answer before we talk about student loans? All right, let's see. I think I have a question that came in. All right, so here's a quick question for the group. So what if you have a good credit score, but your spouse does not have good credit? What's that look like for us? And so I think we talked a little bit about that. It depends on the severity of your spouse's credit and where it's at on the spectrum of credit scores. In that example there, I would encourage that client or a classmate to get connected with us offline after the class. And we could talk more about your spouse's credit. It may make sense to have you as the only person on the application if you can qualify, or it just depends on what the credit score looks like for your spouse. Okay, and just to follow up to that question, looks like that particular spouse does not have established credit. So let's talk really quickly about establishing credit because that comes up as in a lot of my classes. So if you really haven't established credit just because you haven't needed to, that's okay. But I think, if you're considering home financing, there are alternatives to not having a credit score, but you ideally need to have a credit score. So let me give you a couple tips on how to do that. So to establish credit, you can first of all talk to your banking institution. There's generally various Visa, MasterCard, American Express options through your bank. If, depending on what your situation is, there also is secured credit options where you're basically giving a deposit to the bank of, let's say, $300 in order to establish a secured credit card with that institution. So that's one way of doing it. Also, Experian offers, and Experian's one of the credit agencies, they offer what they call as Experian Boost. And Experian Boost allows someone to get to establish credit with additional alternative accounts. For example, like your rental payment, maybe your car insurance, your cell phone bill, things like that. They'll use that as reporting mechanisms for your credit. And it can help. It does, in fact, work. I've seen a lot of clients leverage that. I would encourage you to check that out. You can go to experianboost.com, and that's another way of kind of establishing credit. So question in the Q&A, and then we'll talk about student loans. One more is what is the Fed Reserve and why does it affect the market so much? Good question. So the Federal Reserve is, in charge of kind of monitoring and kind of making sure that our U.S. economy is going the right way, right? And whether we're in a recession or we're flourishing as an economy, the Federal Reserve is managing what the results of our economy looks like. And to my point earlier, the Federal Reserve is controlling interest rate. They control interest rates and the borrowing costs. And the thought process is, the higher we can move interest rates, the better we can cool inflation and the cost of goods. And because you certainly don't want inflation to go out of control, because then the average consumer can't afford, day-to-day goods or household. And so that's the dilemma the Federal Reserve is under. And so they've given the kind of the guidance that they want to see inflation at 2%. And so that's what they're trying to achieve by raising interest rates. And so, it's a little bit of a delicate balance because they don't want to completely stall out the U.S. economy. Because if you raise interest rates too much, you affect one of the major pillars of the economy, which is housing. So we got to be careful with that. And, the housing market has been fairly resilient, believe it or not, even in this high rate environment. But certainly lower interest rates will help fuel more activity in the housing market. All right, great question there. Let's talk about student loans. We'll just kind of briefly go through this. Student loans are in repayment. Federal ones are, for that matter. So from a lending perspective, we do have to look at student loans. Whether you're in deferment or forbearance, there still is a minimum payment calculated into student loans. If you're on an income-based repayment student loan, we take that minimum payment for qualifying purposes. So for example, let's say I had $75,000 in student loan debt and my income-based repayment amount was $250. That's what we'll use for qualifying purposes. Now, if you're not in a repayment right now, then by default, if we're doing a federal housing insured loan, a government insured loan, we take 0.5% of the balances. If you're doing a Fannie Mae conventional loan, we take 1% of the balances. So if you're back in school because you're working on, a master's program or whatever, and you don't have active payments right now, we still have to count a minimum payment for qualifying purposes. Now, in some cases, this, comes up where we have parents that are paying student loans for one of our clients, and that can occur at times. If that's the case, as long as we can show that that parent has been paying those payments for the last 12 months, then we can exclude that obligation from our buyer's monthly payments. All right, let's talk about loan programs. And so we always like to kind of spotlight 5 programs to support our first-time buyers, 2 of which are probably the most common for most of our first-time buyers, but we're going to kind of dive into those. I'm going to give you a little bit of a high-level look at each one of these products. And we'll first start off by looking at the conventional loan product. When you think about a conventional loan, that refers to Fannie Mae, Freddie Mac. You probably heard a lot of that, a lot of those names back in the housing crisis that we had years back. But the Fannie Mae and Freddie Mac conventional product has about 70% of all originations across the country. That loan amount that we can offer through a conventional product goes all the way up to $766,550. So that's the amount financed. That's considered the conforming loan limit all across the country. It's a minimum down payment of 3% when we use that product if you're a first-time buyer. Fannie Mae products and Freddie Mac products usually have a minimum credit score of 620. And they can be coupled with first-time buyer assistance programs to help fill the void of that 3% need for the down payment. Conventional products you'll find will be a little bit less lenient than we will say in the federally insured loan, the FHA loan, which requires a minimum down payment of 3.5%. In most of our southern markets, it's going to go up to $498, $250 in loan amount. FHA is a government insured loan. You're going to learn a little bit more about mortgage insurance for both the FHA and conventional product in just a few minutes. But with the FHA product, a lot more flexibility from a guidelines perspective, allows our credit score minimum to go down to 580. If we've had past challenges, it's going to be a little bit more easier or flexible to be able to qualify that buyer. And then the VA home loan is going to help our veterans achieve home ownership. Minimum credit score is 620. The VA product allows a veteran to be able to purchase with no money down, which is awesome. There also is a VA funding fee as part of VA financing, but for some of our veterans that are eligible, if they do have any partial disability from the VA, that VA funding fee is completely waived. And the VA loan really doesn't have a restrictive loan amount. So some of our higher cost of living areas, veterans can go up to $1 million plus in loan amount and still have the 0 down payment option. And VA loans are going to just be a lot more flexible for our veterans to help them achieve homeownership. And so that's a great resource available for the veteran. And then the USDA product allows clients to purchase in what we would deem as rural areas. USDA does stand for the United States Department of Agriculture. There's two kind of big qualifiers with USDA. There's geography, so you have to be in a deemed rural area. And then there's also an income restriction by household. But the USDA product is a zero down payment option, really popular product in some of our outlying areas. Certainly something we can help service our clients with here. And then finally, the jumbo loan, which doesn't really come into play for many first-time buyers, but it is certainly a product resource available. Minimum down payment of 10 to 15% down. It does require a lot more assets because the buyer is going to need to save up money for both the down payment and closing costs. But jumbo loans also require reserves, which will be generally 12 months of the equivalent mortgage payment that they'll need to have in additional savings. And jumbo loans have a little higher credit score requirement. Usually it's at least a 680 credit score. Most loan programs, when you put less than 20% down, are going to have mortgage insurance. And what mortgage insurance in essence does, it actually protects the lender against default if the buyer was to have an issue financially and just wasn't able to make their payments. There's private mortgage insurance, which is called PMI. There's also government insured mortgage insurance, which would be through like an FHA product. So I want to explain you both sets of mortgage insurance options and then kind of give you a little bit of analysis on what that looks like. So let's first of all talk a little bit about the conventional mortgage insurance. So when we put less than 20% down on a conventional loan, we have PMI. And PMI can take different shapes from a payment perspective. You can pay it monthly. You can split the MI up between monthly and upfront costs. You can do a single premium where you completely buy out the mortgage insurance. You can also have it built into your interest rate where you would elect a higher interest rate to buy out the mortgage insurance. Quite honestly, that doesn't happen a lot, especially in today's market. We just really wouldn't want to elect to do a higher interest rate option. Most clients are going to look at the monthly mortgage insurance selection. And the reason why they do that is because mortgage insurance on a conventional loan has a cancellation option. So once I achieve 2 years in my loan and 22% equity, I can apply to have my mortgage insurance canceled. Now, PMI, many buyers don't know, PMI varies, and it varies based upon my credit score, my down payment, and how much I decide to finance. So some of you in tonight's class have been on Zillow or Redfin and been looking at different payment scenarios. The mortgage insurance, I find, is wildly different than what we offer in financing because of those three factors there. So for example, if we looked at a $250,000 loan amount and I had a 740 credit score and I wanted to put 3% down, my PMI on a conventional loan would be about $135 a month. Okay. Now, the other side of that is the FHA government insured product. There are two forms of mortgage insurance on an FHA loan to be aware of. There's monthly mortgage insurance, which is the equivalent of 0.55% of my loan amount. Plus there's upfront mortgage insurance, which is 1.75% of my loan amount. That gets added into my total amount financed. Different from a conventional loan, the FHA loan does not have a mortgage insurance cancellation option. So what that means is the only way to exit mortgage insurance on an FHA loan is to refinance into, say, a conventional loan product. Now, if we look at the payment scenario for an FHA loan with MI, we have that same loan amount of $250, but now I need to add that 1.75% on top of my amount finance. So now that $43.75 you see on screen gets added into my amount finance. And then my monthly mortgage insurance is in total is about $114 per month. So it's a little bit lower than the PMI for the conventional loan, but a bit more expensive, especially because of the upfront mortgage insurance premium. So many of our clients, as we're meeting with them, they, are looking at different options, and we're obviously going to put these side by side for you and see what makes the most sense. And I think it's important to understand there are options for you because not all clients will be able to get the qualifying completed on a conventional loan. So FHA can be a great alternative for clients that maybe have had past late payments on maybe a credit card or maybe a little bit overextended on their credit, a variety of different reasons. And so, that's why when we meet with clients, we want to provide them with as many different options as available. And then we'll kind of figure out as we build that plan what the best path to go down is. Now, in preparing for homeownership, there are some documents that our buyers generally need to get together. Things like tax returns, W-2s, recent bank statements, pay stubs. So those are all kind of the general requirements in determining eligibility for financing. Speaking of income, I think it's important to understand, some of the rules or guidelines as it relates to income for you, because I get a lot of questions around this, specifically around kind of my work history. So there are rules in lending that require you to have at least 2 years in employment and/or education history. As I work with several different alumni across the country, obviously many of those are graduates from school recently. And so I think it's important to understand that you don't necessarily have to be on your job 2 years to be eligible for financing. The way the rule works is if I had 4 years in Mississippi State, I got my undergrad work done, and now I started my job first of the year, that 4 years I spent at Mississippi State would count towards my overall 2-year work requirement. So in some cases, we even have clients that have a new job offer and they're getting relocated to a different part of the country. We can qualify them off of that offer letter, even ahead of them actually starting the job. So there's a lot of different rules out there that I think it's important to understand so that we can help you navigate towards homeownership. I think where the 2-year requirement rule gets a little bit trickier is that if we have clients that have 2 jobs, we see this a lot maybe in the healthcare industry. If I'm working at 30 hours at one clinic and 40 hours at another clinic, in that case, if I do want to consider both sources of income, I have to show that I've been doing both jobs simultaneously for the last 2 years. Where 2 years also is really a requirement is for our self-employed clients. So if we are trying to use self-employed income, we do have to show 2 years consecutively of tax filings in order to use that self-employment income. And that also holds true for clients that have maybe a 40-hour work week job, but also drive for, let's say, Uber or Lyft on the weekends. If we do want to add that additional income that we have from the weekend employment, we do have to show that I've been doing both jobs for 2 years. And finally, in some cases, we do have situations where clients are applying on their own, but their partner is contributing income to the household. That's great. However, in most cases, that income can't be counted unless that partner is going to be part of the application. All right, last thing I want to touch on with income is a kind of an income versus expense ratio. That's called debt to income ratio. And as a lender, we're going to look at your income that's coming into the household that you're using on your qualifying application versus your expenses. And those expenses include things like personal loans, credit cards, your new mortgage payment with taxes, insurance, maybe homeowners association dues. We take those expenses versus your income and we come up with this formula, or this calculation, I should say. So you can kind of see this on screen. This PITI, we love acronyms in our lending industry, but PITI stands for principal, interest, taxes, and insurance. And then we have PMI, that private mortgage insurance we just talked about. If we're buying maybe in a community like a condo or a townhouse that might have a homeowners association dues, and then we take our other debts versus our income. So in this scenario, we have someone that has $3,000 in expenses, $8,500 in income, and we come out with a 35.29% debt to income ratio. This is a pre-tax income figure that we use. And so it's not necessarily a great metric for understanding affordability. But one of the questions I get from clients is, where should that debt to income ratio be? Well, the guidelines will allow us to go to 45 to 50%, which is a pretty big number. Most clients feel like the comfort zone is 33 to 36% debt to income ratio. But the most important kind of thing that we can kind of go through during your consultation is talking more about affordability. So I'm more concerned about what an affordable number is for you versus kind of what the debt to income ratio is, because debt to income ratio is really only a qualifying metric that we'll use. So the last stop in tonight's class in building kind of a plan for us towards homeownership is talking a little bit about savings towards down payment and closing costs. And that's one of the biggest challenges that I talked about earlier when we kind of launched into tonight's class. Now, there are a variety of different first-time buyer assistance programs available. We'll spend some time talking about it, but I want to cover with you just kind of what's generally required in terms of assets and talk to you a little bit about a savings plan to help you in homeownership. So this is kind of a look at some of the statements that we'll generally need to verify assets, like checking and savings accounts, retirement accounts, if you're going to use that. I would just encourage you, if you're going to use retirements like 401ks, 403bs, talk to your tax advisor or financial planner before you kind of access those investment tools. Gift funds can be also used in homeownership. That's where you're having a family member like mom or dad or uncle help contribute towards your home purchase. There is no seasoning requirement, so those monies can be transferred over right away. We just have to have a paper trail of those funds. And generally, we require a gift letter to be completed by the donor to the recipient. All right. So let's talk a little bit about a savings plan. And this is a really simple kind of approach to savings, but I think it's helpful. And so, as you know, it's a challenge to save in today's market, given everything's a little bit more expensive. What I would encourage everyone to kind of take a look at in their budget is that, and I'll give you an example here to frame this up. But let's say right now I'm spending $2,000 a month in rent. And after I'm meeting with Jason to kind of go through a home buying plan, I think I'm pretty comfortable paying $300 to $3,500 a month. So let's say it's $3,500 a month. Now, maybe I'm challenged a little bit with how much I have savings, but I know I want to buy in the next year or 2 years. What I would encourage that client to do is start paying yourself like you're making a mortgage payment today. And here's what I mean by that. As you're paying your $2,000 rental payment, take the $1,500 that you know you're still comfortable paying, which is the difference of $2,000 to $3,500. Take that $1,500, and you can't think about it, but you just got to push it right into your savings account. And you're basically paying like you're paying a mortgage. So you kind of get into the discipline of paying $3,500 from a budget perspective. And then as you see that money grow in your savings account at the end of 6 months, now we're at $9,000 in savings. End of a year, now we're at $18,000 in savings. And we're not even considering high yield savings accounts, which will give you 3 to 4% in interest on top of that. So what's that? Another $300, $400 a year in interest. So that's, I think, an opportunity for a lot of our clients is to develop savings plans for themselves. It does take discipline, but you can certainly do it as you're working towards homeownership. And that's certainly something we can help out with you during our consultations. There are nationally based first-time buyer programs like the Freddie Mac Borrow Smart program that'll help provide grants to you of up to $500 to $1,500 to help towards closing costs, like we've heard it talk about. In the state of Mississippi, there's the MHC loan product program. That'll provide $6,000 to $10,000 in down payment assistance, and it also offers 30-year fixed mortgages that are at reduced interest rates. So those are things that we can take a look at for some of our clients looking in particular markets. Generally, every state has a housing finance agency or HFA. They might be termed different things in different states, but ultimately those agencies are designed to help support low to moderate income housing. And so those are things that we can get you connected with as part of building a plan for you in homeownership. Now, in getting on that path towards homeownership, we want to walk you through the buying process. And so we're going to talk about the 6 steps of home buying. And you've heard me mention consultation a few times. That's a one-on-one with me to design a plan for you. What we're going to now look at is what the steps look like after we have that conversation. The output of a consultation is to be pre-approved for your home loan. And so the pre-approval allows you to show a seller that you have your financing in place. It shows that you have a sales price that you're eligible for, a down payment, amount financed, and a projected interest rate. That pre-approval is usually good for 60 days. So while you're going through your home search, that pre-approval is valid, but it can always be recertified at any time, especially for our first-time buyers. It can take 1 to 2 years at times to go out and find a home that really works for them. So we don't want you to feel like there's any pressure to go find a house right away. We just want to make sure you have all the resources you need. By the way, in starting that consultation process, we only start with a soft credit check. And the reason why we do that is because many of our buyers are on varying timelines. So we don't want to impact their credit score with a hard inquiry. So we always start with a soft inquiry. All right, step 2 is the house hunting process. So a lot of our clients will do that online and then switch to in-person once they've identified a few homes that really fit their need. I would encourage clients working with a local community realtor. We have a list of preferred realtors in some of our markets, our newer markets. We're kind of growing our preferred realtor database. But at the end of the day, I would encourage you to talk with a local realtor that understands the market conditions, linked or connected with the community so they know what listings are coming online, but certainly talking with a realtor that can also help negotiate with a seller for you. Now, let's assume that we find the home that we love, we make an offer, the offer gets accepted. Now we're going to go to the next milestone in the lending process, and that's called entering escrow, or you basically have a ratified contract with a seller. When that day comes, you're going to get a call from me saying, congratulations, guess what? You now have an accepted offer. And then we walk you through the next steps in the process, including doing a follow-up consultation with us. That's a video session we do for 30 minutes to make sure that we have everything designed properly for you. As a buyer, within the first couple of days of that contract acceptance, you'll need to make what we call an earnest money deposit. The process will start with inspections being ordered by your realtor. We'll also order an appraisal of your property. And then we'll also send you out your disclosures that are reviewed with you during that follow-up consultation. This is kind of what an earnest money deposit looks like. It varies in different parts of the country, but as a kind of baseline, it's usually 1 to 2% of your total purchase price. That money will contribute towards your total out of pocket. It's essentially like a good faith investment in the upcoming purchase. Most contracts throughout the country have what we call as a contingency period set in them that allows a buyer to do their homework on the house and feel comfortable that their deposit is secured. That would include getting the house appraised to make sure the house is worth what you're buying it for, getting your inspections done with your realtor to check for dry rot, roof condition, foundational issues, anything like that goes through the inspection part of things. And then, of course, on the lending side, getting your loan approved. Now, the contingency period is usually in the first 14 to 17 days of the contract. So by the time we get to the very end of the contingency phase, you're probably about 3/4 of the way through the process. Generally, from acceptance of contract to when you get your keys to the house, in most markets, it's about a 30-day process. Now, some other markets, we can shorten that down to 14 days. That's one of our quick close options. But as a rule of thumb, it's usually 30 days. Now, step 4 in the process is more the administrative functions like verifying your employment, your assets. We'll generally have your interest rate locked in by that time. Most interest rates cannot be locked in and secured until you actually have an accepted offer with a seller. And step 5 is going to be the loan approval process. That's where the approval has been issued by an underwriter after they've reviewed your credit, your income, your assets. And by that time, we've kind of almost pushed ourselves to the 3/4 of the way through the process. And at that time, you're probably at the end of the contingency period. So if everything checks out with your inspections, your appraisal, your loan approval, then you'll go ahead and sign off on those contingencies. And that tells the seller that you're ready to move to the final stages of the process. And as a lender, we're going to issue to you your final closing disclosure. What that closing disclosure does, it gives you kind of your final number or expected number of your remaining money out of pocket, and just make sure that everything aligns from a disclosure perspective with everything you've seen through the process. There should be no surprises by the time you get to that disclosure. And then after the 3-day cooling off period has elapsed, then we move to the final closing of the loan day. And that's where you sign final loan documents in person with either an attorney or a notary or maybe an escrow officer. And then after that's completed, then you wire in the final funds of your home closing. So whatever that number looks like, then the escrow team or attorney's office will reconcile the monies that you've deposited along with your loan funds. And once those monies are all accounted for, then they record documents with the local county recorder's office. They'll generally record a grant deed to transfer ownership to you, as well as the deed for the lending. And guess what? Then after all that's all confirmed, we get a chance to celebrate with you because now you're a new homeowner. And it's a great day of and it's a great day of accomplishment and celebration for you. I got a chance to make, I think, 3 of those calls today for our clients in different parts of the country. But it's one of my favorite parts of the day, next to teaching our classes like this. But it's a big deal, right? I mean, this is going to be one of the biggest financial investments you decide to make whenever that time comes. If you're thinking about moving forward in the process, we're here to help support you with all the tools and resources you need. We'd love to be able to get connected with you for a consultation to design your own home buying plan. So if this is a goal for this year or maybe 2 years from now, we'd still love to get together with you. It starts with an online application. We only do a soft credit check, but then you're going to upload proof of your income and assets and then use our helpful link to schedule the video session time that works great for you to be able to connect with me to help kind of build that home buying plan for you. If you have questions after tonight's class that we don't get a chance to ask or answer in tonight's class, get connected with us for an introductory call. We'd love to be able to answer any questions you have, any follow-ups about interest rate or credit scenarios. We can certainly get those answered during those introductory calls. This is what a consultation looks like. It's a free service that we want to provide to you, building a home buying plan for you. Let's talk more about your budget. What's affordability look like for you? Where do you want to buy? What are interest rates looking like for you in your different scenario? How much should I expect to have out of pocket? Do I need to build a savings plan for myself and do some first-time buyer programs work for me? All those things we can discover for you during that consultation. We have some other resources available on mobile. Our mobile app can help you start the application process on mobile or desktop, whatever you want to do. You can follow the different milestones of your loan through mobile. And what's most helpful is that as you're out doing home searches, you can do calculations on your mobile device to figure out what that payment looks like for you. It's available, of course, for Android and Apple devices. So I would encourage you to check that out. We're obviously super proud of our Mississippi State alumni partnership. I just love what we're doing. This is a new partnership for us this year, but Leanna and the team at the alumni office have done a wonderful job and been so welcoming to us. And so we're really proud to represent Mississippi State in our communities and in home ownership. And we have other partnerships across the country. So if you do have friends, family, maybe coworkers that you would think might benefit from our educational platform, these are free classes that we provide out there. So we'd love to have you get connected with us. They can visit mortgageeducate.com. We're going to teach over 50 classes this year in home ownership. So if that would be beneficial to them, they're always welcome to attend. Here's all my contact information. So after tonight's class, if you want to get connected with me, you can message me, call, email, whatever's good for you. As I've mentioned earlier, tonight's class is all recorded. It's going to be up on our YouTube channel tomorrow, along with the presentation material coming to you. And I'd encourage you to follow us on our socials. Follow us on YouTube, subscribe to our channel. You can also follow us on Instagram. We've tried to put a lot of good resources out there for our first-time home buyers to help them on this path towards home ownership. So I know I got a few minutes to spare before the top of the hour, but I want to carve out some time for some Q&A. We've had some wonderful questions already throughout tonight's class, but want to ask our class if we have any other questions that I can help with before we wrap up tonight's session. Any questions out there? Maybe we're typing away, so I'll give us a minute. I think maybe we did it. Maybe I think we're good. Oh, we got one question that came in the chat. Okay. Okay, question was, where's your YouTube channel? So the handle is JMATA Mortgage. So it's right here on our social on the screen. So JMATA Mortgage. You can see every class that we've done. We've probably have about 7 years worth of footage on our YouTube channel. So yeah, check that out. And we'll put up other videos up too. We and just so you know, for our alumni partnership, we host 4 of these classes for Mississippi State specifically throughout the year. So we'll have a couple more this year. So if you have other classmates that would benefit from this wherever they're at in the country, we'd love to have them join us. But yeah, it'd be great to connect with them as well. All right. Well, I know next season, I think for us is football season. So hopefully we'll get a chance to see you at an upcoming game out in Starkville. Let me see. Okay. Thank you for the feedback. Appreciate that. And next